Back last December, the Federal Reserve was still afraid of inflation. Early in December, Jay Powell famously got on his speech and said, "We are not talking about rate hikes. Consumer prices are the biggest threat to the economy." Fast forward 2 weeks later at the FOMC meeting in the middle of December, Powell says suddenly, yeah, we're talking about rate cuts. Even in early January, Federal Reserve officials, several of them, talked about, quote, overly restrictive policies and their fears that maybe monetary policy had grown too tight and therefore was in danger of causing real serious damage to the real economy. But then a couple weeks after that, the Fed comes back and says, no, we're now more afraid about consumer prices all over again. Was it oil? Was it the Red Sea? Who knows? As far as most people are concerned, all they can tell is the Fed keeps going back and forth with no clear handle on what the risks might be, no clear message to the public. Are we in danger of more consumer prices? Are we facing negative downside pressure in terms of the real economy? If the Fed doesn't know, how is anyone else to know? To help me make sense of what's going on in the real economy, forget the Fed, because I know everybody wants to focus on monetary policy, but we're more concerned about what is actually happening on the ground than we are about Jay Powell's ability to interpret that and turn that into some kind of useful message, because message is the actual policy. So to help me do all this, to decipher all of these back and forth, the flip-flopping at the FOMC, Steve Van Meter, what do you make of this, the clear inability of policymakers to come to a conclusion and make it a clear determination, say, this is exactly what we see, and we're confident this is what we see, and this is what we're going to do about it. Instead, they make a determination, then they change their mind the next week. Sometimes it's that fast, and then they go back again.
Jeff, this is like a tennis match. You're just going back and forth, kind of wondering where the Fed is at, because it's really simple. They could just come out and say, hey, you know what? Inflation doesn't go down in a straight line, which we know for an absolute fact. And they could say, hey, you know what? We believe we're in a restrictive zone and we would like to pull back off of that because we really believe that we've nailed this, but we're slightly concerned here. So we're just going to let the data fall where it may. We're going to let this thing run a little longer. And when we see it switch down where disinflation is heading toward our target, we'll pull back on the rates a little bit. And if it doesn't, maybe we'll stay here. Maybe we'll have to raise. But the problem I have, Jeff, is they don't give us a clear message and they can't even interpret the data right. They're getting now where they used to look at this bigger picture. Of course, they were focused on the lag data, as we know. But now it's just like, oh, what about this report or that report? Here's another one. Here's a PCE, CPI. It's like we can't figure out where they're at because the issue is they don't know where they're at. A lot of people believe the Fed really is all knowing. They've got all their economic models and machines and computers and all these people. And here we're seeing in real time, they don't know. In fact, maybe there's something going on that they're actually afraid of. Of course, we saw New York Community Bank have issues. Maybe the Fed is worried. That's never a good sign.
Yeah, I think that's part of the issue here. In fact, that's maybe the big issue, is that if they were confident at all in their interpretation, or, I mean, shouldn't they be confident in their policies? Right? They've had the most aggressive rate hiking campaign in the history of mankind. At least that's how it's told. Shouldn't that be enough? Shouldn't they be say, okay, we're really powerful. We know what we're doing. We raised rates. Let the chips fall where they may. And we know where those chips are going to fall because we understand how the systems work. They're actually telling us, by flip-flopping back and forth, they're showing the public it's not what you say, it's what you do. And what they say is what they do. And what they do is back and forth all the time. Okay, we're going to raise rates. We're not going to raise rates. We don't know how much rates we're going to raise. We don't really know exactly how these things. And as each individual data point comes out, they don't, I mean, the CPI in January was a perfect example. It surprised a lot of people for a couple different reasons, and apparently it surprised the Federal Reserve too. But they should have looked at that and said, okay, this happens. As you're pointing out, Steve, nothing ever goes in a straight line. So every once in a while, you'll get a month where the number will be hot or it'll be cold. And if you were confident in your position and your policy, you would look past that and say, okay, it's a 1 month fluctuation, no big deal. the fact that the Federal Reserve and policymakers react and respond seemingly to every data point that doesn't fit their straight line model is a clear signal that they're just winging it. They don't really have a good idea on how anything works, let alone what the near term future is going to look like.
But something that does seem to know is the bond market, Jeff. So today we get to PCE, and lo and behold, what happens? Interest rates across the board are dropping. And the bond market is telling the Fed, look, you've no clue what you're doing. So if you're not going to be the leader here, which clearly they're not, the bond market's telling them, look, you can forget these one-off, monthly reports. What we know is that financial conditions are tightening here, which is key. A lot of people understand that lower rates mean things are getting worse, not actually better in the underlying economy. So we look to the bond market here and say, hey, wait a minute. It's clearly telling us that something isn't right, that the Fed is not seeing, or maybe the Fed knows but doesn't want to talk about it. Whatever the case is, Jeff, it's the bond market that's got this right.
Yeah, we always look to the yield curve as for not just clues about the near term, but really the longer term probabilities there. And as you pointed out, I mean, bonds have been telling us all along, regardless of the individual monthly CPI reports, that this was the direction the economy was going to take. It was going to become disinflationary, even if it would take a little bit longer than maybe people were hoping for. And so that was always the background. And so the question was, how does the economy become disinflationary? It doesn't just the consumer price numbers don't just magically start to go down. There has to be economic consequences behind the change in numbers, which is where we get into this debate about, okay, what does disinflation actually mean? Is it a Goldilocks soft landing, or is there more behind it? Is there a recession? Is there deflationary potential maybe lurking behind the economic changes that we see going on right now? Because that's another thing that keeps coming up. Despite the January CPI, around the rest of the world too, disinflation has become more and more entrenched over the last several months of last year, and it looks like to begin this year. And we've also seen, I know you talked about this too, Steve, indications that even U.S. consumers maybe have started to pull back here. We just got some figures today on personal consumption and incomes. And incomes went up with the cost of living adjustment from the federal government, but spending did not. And so you have to wonder if part of the disinflation is even in the United States, where the economy is absolutely booming, so we're told, maybe consumers have gotten to the point where they're, even as income was added from the federal government, they're kind of sitting back and saying, well, maybe we're not going to spend it. That's more and more signals, not just in the US, but around the world, that things really did change around October, November into the last part of last year.
Well, and then there comes a question, Jeff, is what are consumers seeing that perhaps we're not, seeing at the Fed level? Why is the Fed flip-floppy here? Is it something they really see or they just don't know? The question now is, if consumers aren't outspending against the fact that the US equity markets are sitting right near or at all-time highs, that doesn't make sense, because usually that's a great barometer. The wealth effect gets people feeling very confident. So as we look underneath, what do we have an issue with? The labor market starting to break. And we see that going on around the world. Here in the US, what would get a household really worried? Well, the fact that continued claims now are back at 1.905 million. It's up 45,000 from last week. So if indeed we had this strong labor market effect and people are feeling optimistic, we should see that continued claims number dropping a lot to going more in line with the initial claims data that still hasn't picked up all of these announced layoffs yet. So my hunch here is that households are starting to realize that, yeah, you know what? Someone in our household lost their job or income went down, but they're unable to find another job, or maybe they're going on interviews and they're being told, hey, you know what, we're interviewing, but we're not hiring. And that starts to get in the psyche of people, and deal comes back right to how they spend and how they're handling their money.
I think that's the worst part of all of this. It's not necessarily the layoffs. The biggest factor in basically every part of the economy and the setback, the disinflation, everything else, is the lack of hiring, regardless of layoffs and firing, because there's all sorts of data discrepancies and debate. I mean, we know there's layoffs happening, yet they don't show up in initial claims. So let's set that aside. We do know with reasonable assurance, even from initial claims, even from government statistics on the labor market that hiring has absolutely plummeted. It has plummeted in a way that we haven't seen outside of serious recession. And we hear all of these mainstream media stories, anecdotes. If you talk to people who are in the economy, even if they haven't been laid off, they are deathly afraid of that possibility because they know if they do get let go or they do get their hours cut, they have no alternative. There's nowhere else to go. So in that situation, you don't even have to be laid off. You don't even have to have your hours cut. Just the threat of that happening, you start pulling back and saying, maybe maybe I won't buy that extra thing I wanted to buy because I might need to save for rent next month. Don't know if I'm going to have the same amount of hours or if I'm even going to have a job. That kind of really hiring freeze just sends a chill throughout the entire economy. And so you get the numbers from the PCE, the BEA this month for January, where incomes were up. Again, the cost of living increases, but spending, we saw retail sales. I know you talked about this, Steve. Retail sales were down sharply in January, despite an increase in income, suggesting, I know economists blamed it on the cold weather, which you just have to laugh, but it suggests that consumers are saying, okay, regardless of the layoff situation or firing, no one is hiring. And the only people who are hiring are what? Leisure and hospitality. So you have a nice job, and if you do get fired or get your hours cut or something happens, the only alternative, you got no chance of getting a moving laterally to the same type of job. You get set way back and become a bartender or waiter or something like that. It's just, that's the kind of situation that can really create some setbacks in the overall economy.
You know, it's really interesting, Jeff. You mentioned retail sales because in the same month, hours worked dropped, retail sales dropped. So I think it's really interesting because you mentioned what's going on in the mind of these workers. It's really, you start thinking, you go to work every day, and what are you seeing? The number of backlogs, those orders that are been on the books for a while, they're not a priority. They keep going lower and lower. And so you think, well, where's the new orders? Well, they're not coming in a big way either. And you start to realize, if you're a worker, that wait a minute, once we get through all these backlogs, I'm not needed. And in fact, what are we seeing in the regional Fed data? We're seeing some, mentions that hours are being cut, or if work doesn't pick up, hours are going to be cut. And then that all starts to materialize back to retail sales as consumers are now saying, wait a minute, maybe the soft landing or no landing scenario isn't going to play out. If it does, great. But maybe I need to start setting some money aside here. Then what do we see? Of course, personal income's up, but spending doesn't match. That's pretty unusual here. So to me, I think that's what's going on is consumers have a much better pulse of what's going on in the real economy than, of course, the Federal Reserve does.
Which just raises the question, what is it that Jay Powell is suddenly afraid of in terms of recent statistics? And it's not just consumer prices. I mean, he's mentioned GDP, he's mentioned payrolls too. But it seems like he's picking all the good numbers, whether he actually believes them or not. It sounds like he's saying that everybody else will believe them and everybody else will buy into the hot economy. We see this in Japan. I don't know. I know you follow Japan pretty closely too. The Japanese are saying, yes, we see that the Japanese economy is in recession right now, but we choose to believe that consumer spending is going to surge in 2024 because of this pent up demand over the last couple of years. Consumers are just going to let it fly at some point, even though the economy is in recession right now and consumer sentiment is in the dumps. We heard the same thing last year in China, remember? Consumers, so much pent up demand after all the lockdowns in the previous years. Chinese consumers were going to come rushing in, and the Chinese economy wasn't just going to explode higher last year. It was going to save the entire global economy and create inflation. It's almost as if policymakers around the world, including the Federal Reserve, have created this fiction where consumers are just going to start spending for whatever reasons, and that will lead to another round of inflation pressures. And unless we do everything in our limited power to stamp that out before it gets started, they're constantly afraid that consumer spending is just going to skyrocket and surge for whatever reason.
But Jeff, I think you just nailed it. The real power of these political leads, the central bankers, isn't actual policy. It's telling people what they should be experiencing. So if you get out and tell people, look, spending's going to go up. You need to go do this before prices get higher. Well, then that people will maybe react and go do that, and that will continue to drive the economy. The problem is when you see them come out and say, look, we really believe all these things are going to happen, and we hope you believe with us because it's really important that you go out and spend money. Well, when the consumers don't believe it, then you get the situation where the central bankers look like complete idiots. And then you have to start to maybe wonder, is that the real reason Powell is flip-flopping back and forth on practically, every 2-week basis? Because he's telling people, look, the economy's got this no landing. I was just on 60 Minutes. Did you not go hear me? And I hear what I said. I did the impossible. And why aren't you out spending and matching this? I think maybe there's some, deep underlying issue here that the Fed really knows something's wrong, but in typical fashion, they don't know what it actually is.
Well, you have to wonder if that's, I mean, if they overreacted to their own overreaction, right? Because they seem to embrace low interest rates, and then some people started to ask, okay, wait a minute, why did the Fed just U-turn and suddenly embrace low interest? Is there something wrong in commercial real estate? Should we be worried about banking? And so maybe the Fed worried that they created an overreaction and now try to walk it back and say, oh, no, 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 no. The economy's doing really well. In fact, the economy's doing so well, we're actually more concerned about consumer prices. But I think that may be giving them a little bit too much credit, don't you, Steve? Because they would then have to be, we would have to imagine a situation where they're actually on top of all of these things rather than just simply blowing in the breeze as each new additional data point comes in. And if it's not exactly what they were expecting, then they got to react to it and change their entire tune. And then another data point comes in, they got to react to that and change their tune back in the other direction. I think that's really what's happening here. But that in and of itself is indicative. If you have faith in the soft landing and no landing and Goldilocks scenario, you don't need to change your tune back and forth every couple weeks. You just say, look, this thing is going to happen. And if the CPI is a little hot or the payroll report's a little soft, who cares? The next one will be just perfect. If you actually believed any of that, you wouldn't need to undertake this flip-flopping, this dramatic flip-flopping in such a short period of time. That's why, you and I, we've been consistent in our message all along. And when you step back and look at the big picture, everything continues to develop just as we expected. You don't pay attention to the monthly fluctuations. You look at the trends. You look at the marketplace, as you pointed out earlier. Has anything materially changed in the trend in the economy, the global economy too, as we see more countries slide into recession? Has anything changed in the marketplace? Stock market notwithstanding, of course. And that's where you look for analysis. You don't need to overanalyze every variation and fluctuation.
No, you don't. But if you're concerned, and we see this at prior peaks in the federal funds, that there's just this great confidence that we've done the impossible, we're doing it, and then something, of course, unexpected shows up, and next thing you know, the economy's into a recession, financial crisis, whatever the situation is, and the Fed's cutting. Maybe this is just simply the case, Jeff, that we've heard from Powell that they went too far in their own mind, that they over tightened to really restrain inflation. Maybe there's something they see. Maybe they're just worried just because they have nothing better to do that they did over tighten. And that's what the issue is. They want to look really good to the public, but they're now afraid that something that they didn't see is going to snap and break and they're going to miss it. Maybe it's just something that simple, or maybe they're crazy.
Well, I think the bottom line here, Steve, is that everything at the Fed is unexpected. So what we're really saying is maybe not put too much stock in what they're doing, what they're saying, or what they're seeing, because they're just reacting to everything. They're sort of like goldfish swimming around, and every little stimuli they have to move back and forth to. So the Federal Reserve, okay, everybody wants to pay attention to the Fed because we're told you have to pay attention to the Fed, when the Fed eventually has to come to grips with what's happening in the real economy. And that's the stuff that we need to be focused on. And that's the stuff we look at in 2024 that continues to move in that same direction, however slowly and incrementally.